Hi everyone, I'm Ifty from CLiK Trading Education. Welcome to this week's market breakdown. As always, this is educational commentary, not financial advice, not trade signals, just helping you understand what actually moved markets and why it matters. This week wasn't panic, it was pressure building. Markets weren't collapsing, they were adjusting. Expectations shifted, traders recalibrated, and when that happens, you often see volatility rise and leadership change. Equities pulled back, crypto softened, and in FX, we saw one of the sharpest moves in USD JPY in recent weeks. Underneath all of that were real economic and political drivers, not random noise. Let's break it down. Here's the broad picture. The S&P, Dow, and Nasdaq all closed lower, roughly between 1 and 1.5% down. The FTSE in the UK held up slightly better. Gold edged higher. Oil was relatively flat. Crypto drifted lower again. But the standout move? Volatility. The VIX jumped nearly 15%. That's meaningful. And in foreign exchange, USD JPY dropped over 3%. That's not small for a major currency pair. That tells us positioning changed. So what drove this? US inflation slowed to 2.4% year over year, better than expected. Normally that supports markets because lower inflation increases the chance of rate cuts. But earlier in the week, we also saw strong wage growth and solid employment data. So markets are caught between two forces. Cooling inflation suggests cuts. Strong jobs suggest rates stay higher for longer. When markets receive mixed signals like that, price action becomes choppy. That's why volatility rose. Technology stocks struggled again. And that makes sense. Tech is very sensitive to interest rates because much of its value is based on future earnings. If rates stay higher for longer, those future earnings are discounted more heavily. On top of that, investors are reassessing AI spending, how much it costs, and how quickly it pays off. This isn't a collapse in tech. It's valuation, discipline, returning. And tech often acts as a leading indicator for broader market risk appetite. Now the big FX story. Japan's election delivered political stability and markets reacted strongly. USD JPY fell over 3%. When the yen strengthens sharply like that, it usually reflects falling US yields, defensive positioning, or both. FX markets are often early warning systems. When currencies move aggressively, equity markets usually follow. The VIX jumped nearly 15%. That doesn't mean the market is breaking. It means uncertainty is being priced. Volatility simply means the range of possible outcomes has widened. Professional traders respond by reducing size and tightening risk. Amateurs try to increase size to make it back. That's the difference. Here's what matters. We're in a data-driven phase, not a crisis phase. Falling inflation does not automatically guarantee rate cuts. Technology remains a risk barometer. FX moves, especially in USD JPY, matter more than most people realize, and volatility equals information. Next week, watch Fed minutes, core inflation, retail sales, and bond yields. Markets most sensitive right now, Nasdaq and growth stocks, USD JPY, gold versus industrial commodities, and crypto as a speculative appetite gauge. Preparation beats prediction. Structure over speculation, clarity over confusion, process over reaction. If you can't clearly explain why you're in a trade, you probably shouldn't be in it. Weeks like this expose weak assumptions. That's not a bad thing. That's valuable feedback. If you found this useful, give it a like, share it with someone who's learning the markets, and subscribe so you don't miss next week's breakdown. We do this to help you understand movement, not chase it. I'm Ifty from CLiK Trading Education. Goodbye for this week. Stay disciplined, stay structured, and I'll see you in the next one.